Hi, I'm Kristen King from the Investing Channel, and you're watching Smart Money, the show that gives you the inside edge on the bets that the movers and shakers on Wall Street are placing. A glance at the data that tracks insider trading tells us an all too familiar tale this week, that of C-suite and major shareholders selling of U.S.-listed stocks. It wasn't all one-way traffic, however. For example, Kelsey Warren, executive chairman of Energy Transfer LP, bought just over 1 million shares in the company at $9.17, an investment of $9.99 million, whilst Clifford Sosin, a 10% shareholder at Cardlytics, bought $25.4 million worth of shares in the transaction and payment intelligence platform. Notable as those two deals are, they were dwarfed by trades on the sale side, and there were some familiar names on this side of the ledger once again, among them ZoomInfo, which we recently covered on Smart Money. ZoomInfo reported earnings on August 2nd, and with that out of the way, insiders were once again queuing up to sell the stock. In fact, just 4 sales of 9,625,000 shares in the company raised more than $2.1 billion. Among those selling were directors Todd Crockett and Jason Mironov. Not that these were the only trades that the two directors made, because just days earlier they had each sold another $221 million worth of ZoomInfo stock. There was also significant insider selling at Option Care Health Inc., where fund manager Elizabeth Betton, her colleague Timothy Sullivan, and their firm Madison Dearborn Partners cashed out. Each party sold 20,700,000 shares in the treatment and home care management business at $20.25 a pop, sales that raised $419 million apiece. Sergey Brin at Alphabet and Mark Zuckerberg at Facebook continued to sell shares in their respective companies, as did Amit Agarwal, the chief product officer of Datadog, who sold just over 272,000 shares in the cloud and server monitoring business at a price of $131.94 to realize sale proceeds of $35.9 million. In fact, it very much looks to us as though the scale and pace of insider selling has been ramping up in what are traditionally some of the quietest weeks of the year in the stock market. Some of that may just be down to timing, or more specifically, the intervention of COVID in 2020, which brought the IPO market to a shuddering halt and delayed the flotation of businesses such as ZoomInfo, which came to the market just over a year ago. It's often, but not always the case, that when a business comes to market, major shareholders and venture capital backers are embargoed from selling the stock after the IPO. Those embargoes can often last for a year. These lockups, as they are known, provide comfort to new investors in the business, assuring them that the founders and backers of the business are not about to sell up and jump ship at the first opportunity. And it also allows the stock to get established in the marketplace without the immediate threat of big sellers. One company that took the plunge and IPO'd in June 2020 was Shift4 Payments, Inc., which came to market at $23 per share. The business provides integrated payment processing and solutions, and fintech stocks such as this have been in demand over the last few years by both stock market investors and venture capitalists. Shift4 Payments lived up to its billing, with the stock trading up as much as 46% on debut and subsequently rising to $104.11 by early September 2020. But since then, shares have fallen around 18% and currently trade around $85. The stock tried to rally back above the $100 mark in late June, but was unsuccessful and sold off once more. Wall Street analysts are divided in their opinion about Shift4 Payments, with 3 strong buys, 3 holds, and 1 moderate buy. And though the stock comfortably outperformed NASDAQ over the second half of 2020, over the last quarter, it's very much been a laggard compared to the technology bellwether, with the index gaining 12.4% and the stock just 3.33%. So a recent sale by one of the company's original VC backers probably won't help the stock's near-term performance. Searchlight Capital Partners sold 4,250,000 shares in the company at a price of $83.75, raising a total of $335.93 million. Searchlight had sold stock back in May and April, and prior to that in December 2020. No one can or should blame an early-stage investor for taking a profit in a recently listed business, not least because they took a significant risk in backing the business in the first place and did so in an environment where there is no easy out. And yet, to see a major shareholder consistently selling down their holding leaves an unpleasant taste in the mouth and makes one think that perhaps something has changed in the business, which no longer makes it an attractive investment to the money manager. That's all we have time for today. As always, make sure you do your own due diligence before making any investment decisions.